Gold has fascinated humanity for millennia, symbolizing wealth and stability across civilizations. Even in our digital age, gold remains a unique, tangible asset, valued for its permanence and security. Unlike paper money or cryptocurrencies, gold's worth isn't tied to government promises or bank solvency. Its price is a global barometer, watched by everyone from central banks to everyday savers. When gold prices rise, it often signals growing economic anxiety and a search for safety. That's why gold is called a safe haven asset, insurance against turmoil, instability, or inflation. Today, December 1, 2025, gold is surging, drawing attention from experts and the public alike. This isn't random. It's a response to major shifts in the world's biggest economies. Understanding gold's movement reveals hidden currents in global finance. We'll break down the forces behind this rally, the Federal Reserve's actions, China's economy, and the weakening US dollar. We'll also see what this means for other precious metals. You don't need to be a financial expert. By the end, you'll understand why gold is making headlines. Gold's story is one of shifting power, uncertainty, and the search for real value. Let's explore why this matters for your money and the global economy. The signals from gold have never been more important. Gold prices have climbed to levels unseen in over a month, with spot gold recently hitting $4,240.55 an ounce. That's a more than 4% jump in just a week, a major signal of shifting sentiment.
Investors aren't just interested, they're piling into gold, both in the spot and futures markets. U.S. gold futures for February delivery are up, showing traders expect this rally to continue. When both spot and futures prices rise together, it's a sign of strong, unified confidence.
This surge reflects growing anxiety in the global economy. Gold's price acts as a barometer for economic fear. When it spikes, uncertainty is brewing. Investors are moving out of riskier assets and into gold security. The strength of this move suggests deep, widespread concern. For most people, these numbers mean one thing: the purchasing power of money is under threat. A 4% jump in a week is a loud warning bell. The financial system's confidence is showing cracks. The gold rally is a global flight to safety.
Gold's recent strength is closely tied to a weakening US dollar. The dollar is the world's reserve currency, and gold is priced in dollars, so when the dollar falls, gold usually rises. Think of it as a seesaw. As the dollar drops, gold becomes more attractive, especially to international buyers. If you're in Japan or Europe, a weaker dollar means gold is cheaper for you, boosting global demand. Recently, the US dollar index hit a 2-week low, fueling gold's rally. This isn't just technical, it reflects doubts about the US economy's outlook. Investors expect the Federal Reserve to take actions that could further weaken the dollar. The market is moving ahead of the Fed, and gold is the main beneficiary. When you see headlines about a falling dollar, think gold is likely rising. This is a global phenomenon, not just an American story. A weaker dollar makes gold more attractive to international capital, creating a powerful tailwind. The current dollar weakness signals to the world that gold is on sale. International buyers are responding, pushing prices higher for everyone. The gold-dollar link is fundamental to understanding today's rally.
At the heart of this market movement is the US Federal Reserve. The Fed controls interest rates, which shape the entire economy. Right now, markets are nearly certain the Fed will cut rates at its December meeting. This expectation is driven by recent data showing a slowing US economy and cooling inflation. With inflation easing and growth stalling, the case for high rates is fading. Investors are acting now, selling dollars and buying gold in anticipation of a rate cut. The market is forward-looking. It's already pricing in this policy shift. The buzz is so strong, it's moving markets even before the Fed acts. The expectation of a rate cut is weakening the dollar and strengthening gold. The market's anticipation is creating the very conditions that make a cut seem necessary. This feedback loop is driving gold's surge.
Rate cuts are rocket fuel for gold for 2 reasons. First, gold pays no interest. So when rates are high, other assets look better. But when the Fed cuts rates, the returns on bonds and savings accounts fall. the opportunity cost of holding gold shrinks, making it more attractive. When rates are near zero, gold's lack of yield doesn't matter. It becomes a top choice. Second, lower rates weaken the US dollar. Foreign investors earn less from dollar assets, so they sell dollars and buy other assets, including gold. A weaker dollar makes gold cheaper for international buyers, boosting demand. So, a rate cut delivers a 1-2 punch. It lowers the opportunity cost and weakens the dollar. That's why investors are buying gold now, ahead of the Fed's move. The current surge shows the market's belief in this relationship. The expectation of cheaper money is making gold more valuable today. Investors are positioning for a rally they see coming. The link between rates, the dollar, and gold is driving this powerful move. Gold thrives when money gets cheaper.
Market jitters are amplified by uncertainty in Washington. A recent government shutdown delayed key economic reports, leaving policymakers and investors in the dark. Without fresh data, the Fed is making decisions with incomplete information, raising the risk of mistakes. Meanwhile, Fed officials are sending mixed signals. Some want to keep rates high, others hint at cuts. This lack of clarity adds to market confusion. The second uncertainty: who will lead the Fed next? President Trump has named a nominee but hasn't revealed who. The leading candidates have very different views on monetary policy, so the Fed's direction could shift dramatically. Until the new chair is named, markets remain on edge. In times like these, investors flock to gold, the ultimate safe haven.
Gold's rally is lifting other precious metals, but each tells a different story. Silver, often called gold's little brother, is surging, recently hitting record highs. Silver is more volatile than gold and benefits from both monetary and industrial demand. Platinum is also rising, valued both as a precious and industrial metal, especially in car manufacturing. In contrast, industrial metals like copper are flat. Copper is a barometer for global economic health. Its stagnation signals weak demand for physical goods. The divergence is telling. Precious metals are rising on fear and currency concerns, while industrial metals lag. Investors are seeking safety in gold, silver, and platinum, not betting on economic growth. Copper's stagnation highlights anxiety about the real economy. The metals market is split. One side signals fear, the other, caution. This split is a key insight into today's market mood. Gold and its peers are acting as monetary assets, not just commodities.
China's economic slowdown is casting a shadow over global markets. Recent data shows China's factory activity has contracted for 8 straight months. This weakness is dragging down industrial metals like copper. Less production means less demand.
China's slowdown signals trouble for global growth and weighs on commodities tied to manufacturing.
But for gold, the story is different. Economic uncertainty in China boosts demand for gold as a safe haven, both within China and globally. Chinese households often buy gold to protect their wealth when the economy or yuan looks shaky. If China's central bank cuts rates or prints more money, the yuan weakens, making gold even more attractive. So, China's troubles hurt industrial metals, but can boost gold demand. The global impact is clear. Gold rises on fear, copper stalls on weakness.
What does this gold rally mean for you? It's a signal to be cautious and prepared. Gold's surge reflects waning confidence in paper currencies and central bank policies. The combination of a weaker dollar, likely Fed rate cuts, and global uncertainty is creating a perfect storm for gold. In times of uncertainty, tangible assets like gold offer security that paper assets can't. The split between rising precious metals and stagnant industrial metals suggests we may face slow growth and persistent inflation, stagflation. In such times, hard assets like gold and silver tend to outperform. The market is sending a clear message about which assets are best suited for the road ahead. Gold's rise is a vote of no confidence in the current system, a flight to real value. Whether you're an investor or saver, now is the time to assess your financial safety net. Consider the risks of inflation and instability. Gold's timeless lesson. In a world of paper promises, holding something real is a smart move.